This is In the Black, a leadership, strategy and business podcast brought to you by CPA Australia.
Welcome to CPA Australia's In the Black podcast, the podcast for business, finance and accounting professionals. On today's show, we're talking about what's on the horizon for mergers and acquisitions activity in 2025. Stephen Craig, CPA, is joining us again to give us an outlook for Australia's mergers and acquisition market for 2025. He's going to take us through Pitcher Partners Dealmakers report. Stephen is a partner of Pitcher Partners, and we've invited him back onto the show to share his insights on the trends, challenges, and opportunities shaping the M&A landscape in the year ahead. Welcome to In the Black, Stephen.
Thank you, Gavin. Thank you for having me back and looking forward to the conversation.
We'll get straight into the questions. And our first question is, could you break down some of the key results in your Dealmakers report, especially around sentiment levels amongst M&A dealmakers you surveyed? And what do you think those data is telling us?
Sure. So we go out and survey a number of different dealmakers throughout Australia, a mixture of corporates, private equity firms, mostly local, some international. The questions are a mixture of sentiment, both looking backwards as to the year that's been and also the year ahead. One of the key questions is a question just around overall sentiment, ease of getting deals done in Australia, opportunities. We've asked this question now for about 5 years, so we're starting to build up a bit of a history and being able to track that against the actual performance. In 2021, which were boom times, that sentiment number was up around the 81%. In the last 2 years, that sentiment dropped down into the 70s. The sentiment score for the outlook for 2025, Dealmakers responded with a 69% response, which is the lowest over the last 5 years. We still see it as a positive number, but certainly sentiment has dropped. If I overlay that against some of the other key findings or key sentiment responses, they're still saying, I think over half, so just over 50% of dealmakers are saying they're looking to increase their level of activity in the Australian market in 2025, and they're expecting deal conditions to be better than last year. Another 30% are also saying they expect conditions to be at least the same. So you're talking about 80% who think conditions will be the same or better, and they're expecting to have the same level of involvement in the market or increased. So it's a bit of a double-edged sword there. Sentiment is down a little bit, but still positive. I'll put a bit of context around that too from some of our observations. The sentiment score from last year was up in the mid to high 70s. Key challenges at the time were around inflation. They were around interest rates. Those challenges, I think there was an expectation that those challenges were almost under control. There was a lot of commentary at the time around interest rate cuts, inflation being under control. That hasn't eventuated over the 2024 year. And so I think this lowered sentiment, conditions have been good for deal making, and I'll touch on the actual results of the 2024 year. But the sentiment, I think, is almost a reflection of a bit of fatigue. When are these rate cuts coming? How are we going to get inflation under control? Those two translate into sort of cost pressures, which have been squeezing both businesses and I think also people's personal bank balances. So I think this 69% is lower, but it's still a positive number. There's still a lot of positive sentiment towards the 2025 year. I mentioned before around how did the 24 year go? Deal volumes were up 2% across the market and deal value was up 30% across the market. So it was a positive year, and it sort of goes against a little bit that drop in sentiment at the end of the year. The other point, and I'll overlay one more component to the 2024 year, values and volumes were up, but there was also a lot of deals that were floated, that were considered, bids put in, that it didn't actually go through. And there's potentially there another way to look at the 24 year is the year that could have been. You're talking about BHP and Anglo, Woodside and Santos, REA Group had a look at Rightmove, and there were several PE deals, Greencross, Novatech, IMED, Guardian, that were all considered throughout the year and didn't get across the line. Now, if those deals, and they're all quite sizable, we're talking well up into the billions of dollars, those deals go through and we're suddenly looking at 2024 in a very different light. So it's probably a very long-winded answer there, but sentiment down, conditions were a slight improvement from prior years, but the outlook is still quite positive for 2025.
I think the report talks about wary optimism or cautious optimism. I think what you said there is quite good, that some deals didn't get up, so that might flow through to this year. We'll probably have some certainty on interest rates. Suddenly, people will start to see rather than just hope that these things will happen.
Yeah, exactly. Cautious optimism is certainly, I think, the right way to look at it. I think people are wanting to do deals. They're out there looking for deals. We certainly get plenty of inbound calls saying, have you got any acquisition targets? So there's plenty of activity in the market, but I think that caution comes through with a lot of deals, or buyers are very happy to run the ruler over a company and spend a lot of time considering. They're not in a rush. So that caution certainly does come through.
So the report details some opportunities and the risks that deal makers have on their radar for this year. What factors are influencing deal makers' confidence and uncertainty for this year?
So, look, I certainly touched on inflation and interest rates, and overall, I guess that pulls together around sort of the uncertainty around the economic recovery. They're the challenges that have been faced over the last 12 months and even a bit before that, and they're still being faced now. Certainly, at least with interest rates, there's probably an expectation they're not going to rise. So that at least adds some certainty, but we're still dealing with higher interest rates, which is impacting cost of capital, impacting businesses' cost base. The respondents look at the Australian market as quite a positive place to do M&A. Australia is considered a low-risk jurisdiction to do M&A, so a robust legal system and regulatory system, which provides buyers with a lot of certainty. The valuations and returns are considered quite positive. Buyers are often able to get good valuations and good returns out of their acquisitions, particularly foreign investors, if you factor in exchange rates as well. We're considered quite advanced from a technological sense, and not just in acquisition of pure technology, but even just in technology embedded into industrial companies or medical companies. It's a technology embedded within the business. And also, I mean, Australia is a pretty diverse place from a business sense. There is plenty of deal-making opportunities across a number of different industries. So we're seen as a pretty fertile hunting ground for deal makers.
Good to have a bit of a positive spin on the Australian market. So that's good to hear. And before this recording, we'll talk about succession planning and how much of a trigger that is for M&A activity. So, and a key driver. But why do you think succession planning is such a factor? And what are your insights into this, particularly with the mid-market in mind, rather than the large market?
Yeah, succession planning has always been, I think, a big factor within the mid-market. And I think it's only increasing in prominence. The mid-market, I guess, if you I don't think there's a hard and fast definition, but if you sort of drew a circle around the bottom end, maybe a $20 million transaction up into sort of a few $100 million, you're talking about your private businesses largely, which are owned by individuals or groups of individuals, often the founders themselves. Like all of us, no one's getting any younger, and succession planning, I think, with an aging population is becoming more and more prominent. Succession planning certainly helps support the middle market, because it's not as determined by economic factors. You talk about the top end of town, you get people who, I've certainly mentioned enough, interest rates, inflation, etc. Succession planning and driving that middle market, there's another factor which is personal. You've got the vendors, the owners of these companies, and they've got personal reasons behind their decision-making. Whether it is lifestyle, they're keen to retire, they're keen to go out and try something else, they're keen to take their money and do something else with it. Clearly, these businesses, more often than not, are a very significant part of their personal wealth. So if they wanted that change in lifestyle, it's often the business sale that's going to have to fund that. Even down to just health issues from an aging population, that can be a determinant of it's time to put the tools down, offload the business, and move on to the next stage of life. So those reasons aren't determined by what's the interest rates doing, what's the economic cycle. That's a very personal decision. And we often find with clients who are in those circumstances, there's an internal alarm in their head. And when that alarm goes off, it almost doesn't matter what else is going on around the world. It's their decision to sell, and that's what they're going to do. So that's a really key driver of the mid-market. It is increasing in prominence. Again, as we see I think the baby boomers are leading the charge, and they're getting into, they're into their 60s, and some are sort of almost approaching their 80s. And so that incentive to transition their business, transition their wealth is only increasing in importance. And whether that's handing down to other generations, or if those next generations aren't interested in the business, then it comes down to most likely some sort of sale process.
The report also talks about strategies for leadership transition. So this is an issue that faces deal makers, but also organisations more broadly. The report lists 7 strategies. 3 look high value, 4 look helpful for some respondents. Could you tell us a little about what those strategies for leadership transition are, and what do you think are most important and valuable, not just in an M&A context, but for businesses more broadly?
Sure. A lot of the responses from our survey do relate quite closely to each other. So when looking to transition a business into new ownership, one thing the buyers will always look at is how do I transfer the knowledge, the skills, the IP. I've bought this business based on what it does. I clearly like what it does. Maybe there's additional opportunities, but at its very core, I want to at least take what it does and then improve later on. So how do you make sure you transition that existing business going forward under new ownership? And our respondents said that the number one factor for them is retention of key employees. So you're probably talking about that layer of management that sits just under the owner or maybe around the owner, because clearly the owner is either stepping completely away from the business or taking a much or significantly reduced role is probably the majority of transactions we see. So it's how do you retain those key employees? And that's a critical factor. There's a number of different components to that. When to bring those key employees into the deal tent? When do you let them know about the transaction? And then how can you incentivize them to be motivated to stay on and work with the new owner, the acquirer, post-transaction? That can be on a number of different strategies, whether it's selling the opportunity that a new buyer brings. Often these companies are selling to a bigger party, so bigger business, bigger party, more opportunities, further growth. There could be financial incentives, bonuses around helping through the transaction, and then a retention bonus. Each case is going to be an individual way, but the key point there is to understand what motivates the employees and how to motivate them to then carry on. And that works on both sides, both the vendor assisting with that and the acquirer trying to work it out so that they keep that knowledge. The second most popular response was around clear leadership handover timelines. Again, it goes to, this transition of knowledge, continuity of the business. Often the buyers will say that they would like the vendors to remain in the business for a transitional period of time, whether that's 6 months, 12 months, out to 3 years, whatever it might be. I think having a clearly defined timeline is really important for everyone involved, the buyer, the seller, and even those other key employees, just so there is certainty around what's happening, when do we need to have all the knowledge transferred by, and when does the vendor actually walk away and any remaining knowledge walks off with them. So it's about creating that certainty for all parties involved. Third most popular response there was around leadership development programs for existing management. I think I've probably touched on it a little bit, but again, presenting that opportunity for existing employees, for key management to further grow, the acquisition becomes an opportunity for them. The fourth one, and I'll put my hand up to say that this might come across as, or I might be criticised as this is more of a sales pitch than a response, but it talks about the involvement of external advisors and consultants. I won't go into too much detail there at risk of any sort of conflicts here, but I think the key point there is that these transactions, again, I'm focusing probably on the mid-market and these private businesses, but these transactions are more often than not a one-off event in a person's life, and also a substantial component of that person's net wealth. And so bringing people in to not only assist with the transaction, but even the preparation phase, getting a business ready for sale, can have a material impact on the success of that transaction. And when I talk about the success, clearly everyone's first thought is probably the dollars, the headline purchase price, the biggest number, the better. The other components are, though, you've got different structures of transactions which can impact not the headline price, but then how those dollars fall down into your pocket. There's a number of different stages, adjustment mechanisms. The tax man comes through and takes a clip. So what actually ends up in your pocket? There's also the preparation phase, and preparing a business can help you maximize the value, but also maximize the certainty that it presents to a buyer. And so if that certainty is there, you've got a better chance of a buyer putting forward their best offer. That best offer might be a higher purchase price, the simple one, the dollars. The other components, though, it might be more favorable conditions, less restrictions, less restraints, less deferred payments, less conditional payments, so more certainty around dollars up front. The third component is having a business prepared for sale, if it's not prepared for sale, the buyer might not even take a look. They might walk away without even, and you don't even know that they're actually a genuine buyer because they'll just say, no, not interested, too hard, there's too many issues going on here. So that's where I think, again, happy to put my hand up and say sales pitch here, but an advisor can come in and help.
I don't see that as a sales pitch. I think it's essential that people go and seek the advice they need. And you made a good point, like this might be the only time they do this in their life. So you do need to speak to people that do this all the time. So you do get it right, you do maximise the value, and the purchaser gets value out of it as well. So
yeah, that's exactly right. And that's from a buyer's perspective, to have an advisor in there on the other side, well, sometimes can hinder because it means you're dealing with someone who's at least somewhat sophisticated, but it also can help smooth the transaction out. You've got someone guiding a vendor who might not understand all the components of a deal. And so from a buyer's perspective, it actually can become quite advantageous to be able to talk to someone who understands transactions. You're talking, on par with somebody else and you're not dealing with somebody who doesn't quite understand the M&A frameworks.
The report states that 52% of respondents said ESG considerations are an essential ingredient to every deal. Another 45% said it's important. That's really not surprising, but going beyond the acronym environmental social governance, why has ESG become so important in the M&A deals that you're looking at?
Yeah, ESG is an interesting one. It is certainly growing in prominence. And as you said, there's no surprise that the vast majority have said it's either essential or a component of most deals. We're seeing that in a number of different fields. We've had stories from potential bidders who have looked at a business, the numbers look good, but they've got, I think in the instances I've seen, environmental issues sitting in the background, and they've looked to acquire a business. They think they can make a good financial return, but there's environmental issues. One of the parties we spoke to, they said their concern was they don't know how they could exit that business in the future because of those issues. So it wasn't the case of buying it and managing it. It's the case of ESG is a growing issue, which they thought in the future, we're actually not going to be able to offload this. So look, our deal makers have responded saying it is of growing importance. They do look at it. And I think the obvious ones is when you're in a deal and they are doing environmental studies, they are doing a review of your governance structures. That's the obvious time when you know it's happening. From a vendor's perspective, where you don't know it's happening, and this is similar to what I said before around preparing your business for sale, you might have buyers who come in and look at it and just go, I'm actually not going to touch it. I can already see there's some issues and I'm not even going to get into it. So from a vendor's perspective, you actually don't know that the buyer was there. So there's a piece there where trying to understand what your ESG issues are, and it's accounting has standards, debits and credits, and there's some pretty clear structures. ESG is not the same way. I think each business is going to have their own specific issues. So it's the first port of call there is for a vendor is to go through and try and understand what are my issues. And I think the best way to do that is to look at your stakeholders. You've got your immediate stakeholders. There might be sort of a ring of the next level out. Understand what their key issues are with your business or potential key issues are. I think the first port of call here is understanding where your potential weak spots are so that you can actually start to take control of them.
Just being prepared for what the purchaser might be looking for.
Yeah, exactly. And look, the other point around that is mandatory reporting is coming up. So I think 1st of January 25, there's already a group, one of the criteria being greater than 500 mil of revenue. There's another cohort coming through that will require mandatory reporting on the 1st of July 26, and then the final cohort, 1st of July 2027. And that final cohort, that's for businesses greater than 50 million in revenue. There's some other tests there around, I think, asset bases, but 50 million in revenue starts to catch a lot of businesses. So I appreciate when some people sort of say it's another burden, it's another cost of doing business, it's a challenge. Why does it impact me? But reporting requirements are coming, and for businesses greater than 50 million, it's going to catch a lot.
And for the listeners, Stephen's talking about climate-related disclosures in Australia. Just going back to what's on the radar for 2025, what industries do you think are most likely to see M&A activity in the coming 12 months? And maybe could be some of the drivers behind why those industries are at the top?
Yeah, look, TMT, technology, media and telecommunications, that ranked number 1 on our survey from the respondents. It has been near the top or at the top of our survey response for a number of years. One of the key drivers, I think, in this group is around AI. We're talking about large language models within finance, within healthcare, within retail, and businesses are acquiring other companies with those AI capabilities, often to enhance data-driven decision-making, analytics, and unlocking new ways of doing business. So AI-powered innovation, from predictive analytics to customer service automation. I'm sure everyone's seen those YouTube videos of the AI salesperson talking to a potential purchaser. You can't tell that person is actually speaking to a robot, which is a little bit scary. But those sort of advancements in business operations, I think buyers are really keen to look at businesses who have adopted and created something within that space and then take it on board themselves to overlay it into their existing business. Industrials and chemicals is another far less exciting group, but a really stable group within the Australian economy. Our respondents have ranked them as number 2. Again, they sit typically around the top as well. Anything that sits within that category, anything that sits within fueling the transition towards sustainability, increasing efficiency, reducing emissions, and then going back to those ESG expectations, they're obviously very popular as well within those industrials and chemicals.
Well, I found the report really interesting myself, and last year I read the mid-year report, and now I've read this one. Before we wrap up, are there any other key takeaways or predictions or anything else from the report you'd like to add for the listeners?
Yeah, certainly. Look, I was nervous. Is this the point where you sort of want me to put my neck on the line and give a prediction myself? And 12 months' time, you tell me where I went wrong.
Yeah, what's your prediction? No one ever goes back and looks at predictions.
I'll hold you to that. Look, I think I won't get you too excited by this, but where we are right now, I think deals are continuing to get done. That's probably one of the key takeaways. The 2024 year was positive, increased volumes, increased values. I should mention that mid-market was down a little bit, but the overall market was up. So there's two sides to that story. So I think overall M&A activity at the moment is solid without being spectacular. The responses in our survey clearly show that sentiment is slightly down, but is still overall positive. There's still a majority of parties who say we're going to do the same, if not more, in the coming year. Where to for 2025? I think what we're going to need is one of these catalysts that we've talked about to occur. A decrease in the interest rates, driving sort of the cost of debt, acquirers' cost of capital, driving that down. Another one might be around some of those mega deals, those larger deals that we talked about, them coming back to market. There's also the federal election. It's not so much a key driver as to whether the market's going to increase or decrease, improve or decline, but it's more a case of there's a little bit of uncertainty there around it. And it's often just a little hurdle that we need to get past before things can free up and off they go. So if I had to put a prediction down, I would, and I don't think this is overly controversial, I would suggest that I think we're going to continue at current pace, probably through the first half of the year. I think we're going to need to see some sort of catalyst to give the market a bit of a shot in the arm, and then potentially we might see a stronger back half of the year. That's probably what I see happening. The survey itself did rate several factors that they thought would be the key drivers of the year to come. Interest rates we've talked about. Foreign investment was number 2 for them. And I think that probably ties back to interest rates. Interest rates have dropped overseas, particularly in the US. I think it's had 3 rate cuts already. So a few rate cuts there. You've got Trump now coming into power and what he does for their economy. There's some speculation that he'll rev that up. So there might be some more outbound funds. And then PE. And PE is typically ranked in the top 3 year after year, mostly because of the constant claim of the amount of dry powder. And there is. Last year, I think it was circa 21 billion, of dry powder that needed to be deployed. I don't have the current year figure, but my understanding is that number has increased. That's been consistent for a number of years. The other component with private equity is the need to actually sell off assets. Private equity comes with almost a 2-pronged approach now to drive 2025. I mentioned before several transactions that didn't get through from private equity, and so they'll still be on the cards as potential acquisitions or transactions, I should say, for 2025. So private equity could be a driver of the market on 2 fronts. And then obviously we've talked about succession planning. That I think is going to be underpinning the mid-market. It has done that consistently over the years, and I think it's only growing in prominence, which again will help support the M&A activity in 2025.
Well, I hope it is actually a strong year because M&A activity is actually good for the economy. It can lead to improved businesses, improved economic activity. And I know that succession planning is part of it, but new blood, new ideas, new money coming in, it's actually good for business and good for the economy. So I hope 2025 is actually a good year and a busy year for you. Thanks, Stephen.
Thank you.
That was Stephen Craig, partner at Pitcher Partners. And that brings us to an end of today's episode of In the Black. If you enjoyed this episode or found it helpful, be sure to subscribe to In the Black wherever you get your podcasts and leave us a review to let us know what you think. For more resources, insights and updates, check the show notes for this episode where you'll find a link to Pitcher Partners report and visit CPA Australia's website at cpaaustralia.com.au. Until next time, thanks for listening.
If you've enjoyed this episode, help others discover In the Black by leaving us a review and sharing this episode with colleagues, clients, or anyone else interested in leadership, strategy, and business. To find out more about our other podcasts, check out the show notes for this episode. And we hope you can join us again next time for another episode of In the Black.